Welcome to KNN. KNN is brought to you by Bob Knakal, Chairman of New York Investment Sales at JLL.
Hi, I'm Jon Hageman, Managing Director at JLL. Welcome to KNN. Today I'm here with Bob Knakal, Chairman of New York Investment Sales, and today we're going to look at the New York City investment sales market over the last several decades. So Bob, you've been doing this for 36 years now approximately, and although we just did last week the numbers from the 2019 investment sales numbers, it was the year-end numbers, but it actually was the numbers last year and the last decade. So I know today we want to talk about what the markets looked like over the last several decades, but why don't you tell us first what we saw from 2010 to 2019 and how that compared, to the decades before that?
Well, Hags, I think the interesting thing about looking at the investment sales market over the long term and from a big perspective, and if you go back to 1984 when I started in the business, it was a completely different world. Technology particularly was very, very different. Back then we had no cell phones, no computers on our desk, no fax machine. It was a very, very different world. The pace of business is so much faster today. It's really remarkable, the difference that we've seen over a relatively short period of time.
So Bob, with that being said, you would think that the speed at which we can accomplish things today would lead to more activity in the investment sales market than you saw when you first started your career.
That's the school of thought. You would think that's the case. And I think that it's interesting how technology has impacted things. But if we go back and we look at what happened in the 80s, the 90s, the 2000s, and the 2010s, it's been really, really interesting. There actually was more sales volume in the 1980s than there is today. And it has gone down, actually. There was more sales volume in the 80s than the 90s, more in the 90s than the 2000s. This past decade, we actually saw a little bit of an increase, but generally, there's still less volume of sales today than there was back in the 1980s without all that technology, which I think is a very interesting thing.
So Bob, with that being said, why don't you give us some perspective on the actual numbers, as I know you probably know them off the top of your head.
Ags, as you know, we always look at volume of sales from a turnover perspective. When we're looking at number of properties sold, we take the total stock of buildings in the market, look how many have traded, and come up with a turnover ratio. So as it turns out, in the 1980s, the turnover ratio was about 3.02%, which is the highest that it's been over the past 4 decades. That consists of about 8,350 properties that sold in the 1980s, or about 69 per month. That was the highest that we've ever seen. In the 1990s, there were 6,710 sales. That was 56 a month, and a turnover ratio of 2.43. And in the 2000s, there was 6,080 transactions, which averaged 51 per month, and the turnover ratio there was 2.2%. Then we get to the 2010s. In which there was 7,742 properties sold. That's a turnover ratio of about 2.8%, which is just slightly above the long-term average of 2.6%. These numbers are interesting because that 2.6% turnover ratio tells us a couple of things. One, it tells you that there's not a lot that sells in any one particular year. Also tells you that on average, when someone buys a property in New York, they own it for about 40 years before they sell it. So these numbers are very, very interesting.
So Bob, we talked about how the pace of business has changed over the last several decades, but why do you think the turnover rate is going down as opposed to increasing with that increased pace?
Well, the technology is what's enhancing the ability to work faster. But I think what happened, if you look back at the market in the 1980s, I think there were a lot more brokers and a lot more brokerage companies. And so I think what technology has done is actually has enabled fewer people to do a lot more. If you look at some of the years we've had over the past few years, there is no way we would have been able to do that volume back in the 1980s with the technology that we had at that point in time. So I think technology has actually empowered fewer people to do a lot more. And if you look at the way the population of brokers has grown or shrunk, it's very indicative of the fact that technology is empowering some and limiting the field of people who are actually in the market doing business. I don't know the numbers, but I would bet that if you looked at the number of licensed brokers in New York City in the 1980s, it probably was a heck of a lot more than there are today.
Bob, you talked about the long-term average turnover rate being about 2.6% over the last, 4 decades. What were the bright spots or the highest numbers that we saw over the last several decades?
Well, the highest turnover rate we ever had in Manhattan was in 2012. And that was caused by a couple of externalities. One was that there was an embedded increase in the healthcare law that would increase capital gains taxes by almost 4%. And if you look at the rhetoric leading up to the elections in 2012, many people were talking about increasing the capital gains rate even further. So we had an impact on the market where we saw a huge spike in activity. So we had a 4.3% turnover rate in 2012, which was the all-time highest. The 2 years behind that, both clocked in at 3.9%. One of those years was 2015, which was a natural peak of the market cycle. And the other was 1998. And if you recall, probably don't recall, Hags, too young, but in 1998, the Clinton administration dropped capital gains taxes from 28% to 20%, causing a spike in activity. So the market is highly reactive to changes in policy. And if you look at the market going back to the 1980s, you'll see that 3 of the top 5 years in terms of the volume of sales were created by either folks rushing to beat an increase in taxes or taking advantage of a decrease in taxes shortly after the decrease was enacted. So market participants in commercial real estate are highly reactive to changes in tax policy.
So Bob, that's where we've been historically. What do you think is going to happen over the next decade in the 2020s?
No, that's a great question, Hags. I don't know. I think that we'll see a very, very different world in 2030 than we have today. Certainly, I think the advancements in technology are accelerating at a very, very fast rate. Certainly, we're going to look back on 2020 and probably laugh that we're using email and cell phones and things like that. It probably will change in ways we can't imagine. I think that policy changes will have a big impact. We've seen what externalities have done to the market. We see what tax policy does to our market. We see what new legislation and regulations have on the market. So I think a lot of that has to do with where our political headwinds or tailwinds might come from. And so it's really impossible to say. We're just hoping for a robust next few years, and we'll see what happens after that. But it's been a wild ride, a great ride, and I think that it'll be very, very interesting to see what happens as we get further into the decade.